Okay, so we switched gears now, and we're going to talk about this concept called partnership accounting. Some of you might be fortunate to go in business with other people. Okay, we call those partners in the business. Let's say Leland and Darius, they're interested in starting a clothing line type business. Okay, oh, yeah, that sounds exciting. So, Leland and Darius, the way it would work is the two of them would get together and talk about forming a partnership. They would figure out who's bringing what into the business, who's bringing what assets into the business to start it, who's bringing in the cash, who's bringing in the equipment and the buildings and all this stuff. And then once we've identified that, we form the partnership. And so we're going to talk about how to account for a partnership. Talk about the characteristics and all that good stuff. Okay, so when we form a partnership, there's a couple of things that take place. We first need to identify what kind of partnership it is and all the things that come into forming a partnership. The first thing that Leland and Darius would do in this example is they would form what's called a partnership agreement. It's a legally binding document that identifies all of the things that each partner is bringing into the business. Okay, call it a partnership agreement. It also helps to identify the share of the business, what percentage each of the partners own in the business. Along with that partnership formation, we also talk about things like limited life. How long is this partnership going to last? Liability, who's responsible for what when stuff hits the fan? Who owns the property? What's going on with the mutual agency? Are we going to have some proxy voters, etc.? What about taxation? Who's responsible for paying the taxes? And of course, any type of voluntary association between the partners. So there's a couple of different types of partnerships that Leland and Darius can choose from here. There's a general partnership, limited partnership, limited liability partnership, an S corporation, and a limited liability company. Okay, I'm sure a lot of you have already heard these terms before from your Introduction to Business course. Just to kind of understand the general characteristics of these different types of partnerships, we need to look at which one makes the most sense for your type of partnership and for your needs. How does the taxation work? What's the liability look like? Those are really important questions to ask. So if you're asking me which one's best, that's a good question. For me, I like to limit my liability as much as possible. I don't want to get sued personally for something that happened in the business. Yeah, that's just me. So I'd be interested in something like an S corp or maybe a limited liability company. That's just me, though. And so yeah. Take a moment to explore those. When it comes to selecting one of those, I like to look at it from the perspective of the liability and the taxes. Limited liability, if it's yes, it's for me. For the taxes, in most partnerships, the taxes are shared by the partners. And the taxes actually trickle through to your personal tax forms. In most partnerships, unless it's a C corporation. C corporation, the company acts as its own entity. The company itself is responsible for the taxes. The company itself is responsible for the liability. in a C corporation, the business acts as its own person. Yeah. But in most partnerships, a C corporation is not usually a feasible option. Important to know that. So let's form the business. Let's form the partnership for Leland and Darius in their new adventure of this clothing business that they're creating. So the first thing we do is that the partners both invest assets and liabilities into the partnership. So let's say Leland's going to bring in $25,000 in cash. Darius took out a loan and is bringing in another $10,000 in cash. But Darius is also bringing in $30,000 worth of equipment. Okay. So here we can see both partners are bringing different types of assets and liabilities into the business. Assets and liabilities are recorded at their market value when they're brought into the business. Not necessarily the purchase price, but the market value. So, Leland bringing in $25,000 in cash, that's just $25,000. It's cash, right? That is the market value. But for Darius, the equipment that's being brought in, we would have to figure out the market value for that equipment. The asset contributions increase the partner's capital accounts and withdrawals decrease their capital accounts. On the balance sheet under equity, recall that we talked briefly about this. There's an area called capital accounts. Yeah? Owner's investments, owner's contributions, sometimes is what it's called. What this represents is the amount that each partner is bringing into the business. For Leland, the cash the cash is Leland's bringing into the business, that will be a part of owner's capital for Leland, $25,000. For Darius, it would be the value of the equipment minus the loan plus the cash. Yeah, that would be Darius' balance for the capital account for Darius. And then, of course, through the partnership agreement, the partners get to share in the net income. So the amount of revenue the business brings in minus all of the expenses equals that net income. That net income the partnerships get to share in. If it's a net loss, they also share in the loss, meaning they have to cover that loss. So how does the partnership form? Through the partnership agreement. Partners' withdrawals are debited from their own accounts, their individual ownership accounts within owner's equity. Partner capital accounts are credited or debited based off of their shares of net income, based off of the partnership agreement. How much of ownership does each partner have in the business? Each partner's withdrawal account are closed out through the closing process at the end of each year, are closed out to their capital accounts. But you know that through the closing process. Let's look at an example. In this example, I have two individuals, two partners. I got Kayla and Hector. They decided to organize a partnership called Boards. It's a pet boarding business. They board dogs and cats and other pets that owners like to bring while they go on vacation. Somebody's got to watch the animals. So they bring them to Boards, where Hector and Kayla will take care of the animals. So they decide to create this business. So when they create the business, each owner is going to bring something in. So Kayla, she brought in $7,000 in cash plus a $33,000 building. She also brought in a loan, no payable, $10,000. Hector brought in $10,000. Okay, so we first establish their capital accounts. First, let's do Kayla. We debit cash, $7,000. We debit ring facility, building, $33,000. We credit note payable, $10,000. That gives Kayla a capital balance of $30,000. How did we get $30,000, you might be asking? We add up all of the assets, $33,000 plus the $7,000, that's $40,000. Minus the liability, $10,000. Gives her a balance of $30,000. For Hector, this is easy to figure out. In cash, that's it, $10,000. Debit cash, $10,000. Credit, Hector, $10,000. So the partners brought in the assets and the liabilities. That's step one. Step two is going to be based off of their locations. The partners brought in a certain amount, right, of assets and liabilities. So therefore, we need to figure out what is the percentage of ownership for each partner. How do we do that? There's a couple different ways we could figure this out. We do it by percentage, which is probably the easiest. Okay, 100% of the business, based off of the amount of capital for each owner. Kayla had 30,000. Hector had 10. Well, it should be easy to figure out. It means that based off of that pie of a total of 40, 75% of the business, round up, would be Kayla's. The other 25% would go to Hector. Simple. You could also do it by ratio. You could do it by the capital balances, like I just did. Or you could also do it by any type of salary. In this example, the partners are not employees of the business. They're owners. They don't receive a salary. Profits and losses of the partnership are divided upon ratio that they agreed upon. Okay, cool. So based off of that, in our example, here's the ratio. Kayla is 2/3 owner of the business, and Hector is 1/3. Okay, cool. That's the ratio that they agreed upon. So based off of those allocations, would allocate any net income that the business receives or net loss that the business owes. So here we have some net income. The business brought in a net income of $60,000 in the first year. Great. So what that means is we allocate 2/3 of the $60,000 to Kayla and 1/3 of the $60,000 to Hector. So the way we do this, 2/3, okay, times 60,000 is 40,000 to Kayla and 20,000 to Hector. So debit income summary, 60,000, because net income was 60,000. Credit Kayla, 40, credit Hector, 20. Because remember, it's a partnership, they share in the net income. So based off of those allocations, their total balances change from the ratio, 2/3 Kayla, 1/3 Hector. So in other words, 75% to Kayla, 25% to Hector. The beginning balances. Kayla had 30,000, Hector had 10,000. Based off of the agreed upon ratios, we allocate the net income. The net income was 60,000 times 75% for Kayla increases the allocation for Kayla to 45,000. For Hector, it's 15. That's how we allocate the net income. So, of course, that bumps up their total balances. Within the partnership agreement, they've outlined a couple of other requirements. Hector, or wait, which one is Hector again? I already forgot. That's Hector. Zane. No. Kayla receives a $36,000 annual salary allowance, and Hector receives a $24,000 salary allowance. Each partner is allowed an annual interest of 10% on their capital balances. Any remaining income or loss is shared equally. So let's say, for example, that the company in the first year had a net income of 70,000. How do we allocate that? The net income was 70,000. We have some salaries that were paid out. Kayla had 36,000, Hector had 24,000. They also received 10% interest on their initial investments. So Kayla would receive 10,000 and Hector would have 1,000. So total salaries plus interest. Kayla has 39,000 and Hector has 25 for a total of 64. So we take net income minus the total salaries and interest to find the balance of the remaining net income, 6,000. That gets shared equally according to the agreement. So each gets 3. And that brings their balances for Kayla, 42,000. For Hector, 28. Let's say that they didn't do so well the first year. Instead of that 70,000, they only brought in 50,000. Well, okay. Remember, the agreement still governs this partnership. Net income was 50. They still have received the same salaries. So Kayla still gets her 36, Hector still gets his 24. They still get the same interest, 10% on the original balances. 3 to Kayla, 1 to Hector. So 39, 25, still the same, right? 64. So we can see, wait a second, that's higher than an income. You're right. According to the partnership agreement, the partners share equally in the balance, even if it's negative. So what does that mean? Negative 14,000 gets shared between the two partners equally. That's minus 7,000 to each, bringing Kayla's balance down to 32 and Hector's down to 18. The financial statements, they're drawn up the same way as any other company. The only difference here is that the equity, statement of owner's equity, is a little different. Break it out by each partner. That's what this shows us. Sometimes partnerships change. A partner might leave the business. We might get a new partner. Somebody else wants to join our business. Great. Let's admit them into the business. How do we do that? I got a new partner. They want to join our business. We already have Kayla. We already have Hector. New person wants to join them. Great. So let's admit them. We have to, of course, dissolve the existing partnership because we got to create a new one. We had 2 partners. Now we're going to have 3. Can't run the business the same way. So we dissolve the partnership and create a new one. It could be formed immediately. Absolutely. The new partner can join the business in 1 or 2 ways. The first way is they purchase a share of the business from one of the other partners. Or they can invest assets into the partnership. Bring in some cash, bring in some equipment, whatever. A partner can either buy shares directly from one of the existing partners, or they can invest cash into the business, or whatever. So let's look at it from both examples. Here we have an example. New partner. Tyrell decided to join the business. Okay, so now we have 3 partners. We got Hector, we got Kayla, so now we have Tyrell. So here's what we got. Before the new partnership, Kayla had 52,000 and Hector had 26. Tyrell just joined, so there is no prior balance. Total balance 78. The way that Tyrell decided to join the business was to buy share of the business from Hector, 13,000. So the way that works is we're taking it out of Hector's account and we're putting it into Tyrell's, 13,000. So we debit Hector, 13,000, credit Tyrell, 13,000. So that's how we would introduce a new partner into the business for them buying shares from an existing partner. The other way that they can join the business is by simply investing cash into the business. Let's see what that looks like. So Tyrell decided to join the partnership just by simply putting Tyrell's own cash into the business of 22,000. Great, no problem. Debit cash 22,000, credit Tyrell 22,000. Now, in some instances, depending on that partnership agreement, there might be bonuses that get paid to the existing partners of the business for the admittance of a partner. That's a possibility, absolutely. So to the old partners, they would get paid a bonus. And the new partner may or may not receive a bonus depending on the needs of the business. So how does a bonus get paid out to the old partners? Let's say, for example, Kayla and Hector agree to accept Tyrell into the business based off of the investment of $42,000 in cash into the partnership. Tyrell receives 25% ownership in the business. Any bonuses are attributable to the existing partners and are shared equally. So, in this case, the total partnership equity goes up. We take the existing partners plus the new partner equal the total partnership equity. In this case, it's $1,200,000. Times the 25% interest in the business equals Tyrell's equity balance of $30,000. That clearly means that the difference went to the existing partners. So how does that work? Invest 42,000, balance is 30. The bonuses get paid equally to the two partners. So cash 42,000 minus the 30,000 balance equals 12. The 12 gets shared equally to the partners. So 12 divided by 2, 6. $6,000 bonus gets paid into the capital of the two existing partners. That's how that works. Let's say the agreement said a bonus even gets paid to the new partner. Great. The new partner owns 25% of the business. They brought in an investment of $18,000 in cash into the partnership and is expected to receive 25% of the business. So we go through that same process. Current balance of the existing partners plus the investment of the new partner equals the total partnership equity times 25% ownership for the new partner gives the new partner's equity balance of $24,000. Based off of the agreement, 3 partners receive a bonus. So the way it works is we take the cash coming into the business, we debit the bonus amounts by half from each of the existing partners, and it gets paid into the balance of the existing partner, or I'm sorry, the new partner. So that's how bonuses work with partnerships. Now let's talk about the dissolving of a partnership, or what happens when a partner decides to leave the business for whatever reason. Either they decide they no longer want to be in the business, or they pass away, or they just decide, hey, you know what, I'm done. Partner withdraws from the business. We have to account for that, of course. So a partner can either sell their existing shares of the business to another partner, or can sell it to someone else, or they can take a distribution of their share of the business and walk away. So let's say one of the partners decides to leave the business. So Hector decides, hey, you know what? Been a good run. I'm going to leave. So that leaves Kayla and Tyrell to run the business. So Hector's out. Kayla and Tyrell are still in. So when Hector leaves, he gets paid out his balance. So debit Hector's account, $38,000, credit cash, $38,000. In this example, there's no bonus being paid out. Well, let's say that there's a bonus being paid out. Hector gets his balance is $38,000, $34,000 is cash, and then an additional $2,000 come from the remaining partners in the form of a bonus. And so Hector will ultimately receive the $38,000 that way. Okay. So here's the bonus. So Hector, the original balance was $38,000, receives a bonus of $1,000 from each existing partner, and receives a total of $40,000 in cash. Unfortunately, sometimes life happens and one of the partners may pass away. And so that's why that original document is so important, right? Because it decides what happens when something like that happens. Usually the partnership is dissolved and the individual's estate is responsible for that partnership. Any type of loss or gain, the estate gets it. What happens when the business decides to go out of business? They liquidate the partnership. So the gain or the loss is distributed based off of their respective ownership positions. All the partners are responsible for paying any remaining liabilities, and there's a distribution of any remaining cash and other assets to the partners. So here we have an example. The three partners decide to close up shop. There is, they have $178,000 in cash, $40,000 in land. They have a $20,000 bill, accounts payable. So they have to satisfy the accounts payable first, and then they can receive the cash and land distributions accordingly. So here's how it works. First thing we do is, we pay that 20. Well, actually, the first thing we do is we allocate the land by selling it. So sell the land. We sold the land for $46,000. We debit land, and then we credit gain from the sale of the land. Take that gain from the sale of the land, and we credit it to the three partner accounts. Second step is we got to pay that $20,000 bill. So debit accounts payable, credit cash. So at that point, we have a large cash balance. Cash balance is $204,000 based off of our T accounts. And so we need to distribute that to our partners. And so that's what that last part shows us. If the business has a money problem, okay, not enough cash to pay out everyone at the time that the business dissolves, after the liquidation process, the partners they have to pay into that deficit. Meaning, not enough cash, the business has to pay bills still. Partners have to come up with that cash to pay them. That's what capital deficiency means. So here we have the example where the three partners decide to dissolve. There's a balance of $19,000 left. There's not enough cash to pay that, so the owners have to bring in cash together in order to pay off that remaining debt. That's what this shows us. Now, if there's a situation where one of the partners cannot pay for whatever reason, their account gets dissolved and transferred to the other partners, and then those remaining partners pay out any remaining balances. That's what this shows us. And then, of course, a couple of ratios you need to know about. One of those is called the partner return on equity. This tells us the percentage that the respective partners are contributing to the business. We take the partner net income divided by the average partner equity. Remember, to find the average, beginning balance plus ending balance divided by 2. That, my friends, is the end of our discussion today on partnership accounting. Are there any questions at all on partnership accounting? Or did I do an okay job? Anything at all? Partnership accounting.
I don't believe so. I was going to ask something about return on ratios, but it's kind of it shows. I think the ending slide it shows you how to do that. So I don't think I have any problems. I just got to look back over.
Okay. All right. Cool. Thanks. Are there any other questions, comments, concerns, anything at all? Ratios. Okay. All right. Great. Yeah, this was a good session. Hopefully you all got something out of it. Anita, I'm sorry. I'm just now seeing your question from earlier. What about a patent? Patent. Was that with respect to our discussion on the liabilities?
I forgot. I think it was partnership.
The partnership. Oh, okay. Yeah, great. Yeah, excellent question. So let's say a partner brings something like a patent into the business as a form of assets being brought in. So a patent, as you know, is an asset to the business because the patent's used to help to generate revenue. Let's say one of the partners brings that in. The way that works is based off of the remaining amount of time on the patent and the total cost of that patent, the amount would kind of be prorated, if you will, based off of the remaining balance of that patent at its face value. And so that amount would be allocated to that individual partner equity account. That's how that would work. It's similar to the way other fixed assets work in that regard. But yeah, that's how a patent would work. That's a great question. Excellent question. Hopefully that helped to answer your question. Okay. Are there any other comments, questions, concerns? Okay. Just to recap for this week, we're in week 6 already. I know that's quite amazing. It's amazing to me how quick time goes by. So just to remind you of what's due, when it's due. Under Engage and Explore, you have a LinkedIn Learning certificate for this week. So go ahead and go through that. There's going to be, just like before, it'll open up. There's going to be a whole bunch of videos. You got to sit through the whole thing. Make sure the little green check marks appear next to every single video because that indicates that you watched it. And at the very, very, very end of it, after you've watched the conclusion part, it'll come up with a certificate. And that certificate shows up. You want to click the LinkedIn Learning Certificate. And of course, click Download PDF Only. And if you have your LinkedIn Learning account, post it. Yeah, so it's always good to post. But download PDF Only. It'll download to your computer. You'll come back to the classroom. And you'll upload here. Yeah, just like you have done before. So you'll have that due by Sunday night. I recommend that you do that in class time on Thursday. Right? That in class time on Thursday. And then, of course, you also have the Chapter 11 quiz and the Chapter 12 quiz. Also, both of those things due on Sunday night. I recommend that you take some time throughout the week to complete those. Never wait to the last minute to do stuff. It's always best to pace yourself throughout each week, so that way you don't become overwhelmed on Sunday night. That's my recommendation. Any comments, questions, concerns? Yeah, Leland.
I was just saying, no, I don't have any questions.
Okay, great. Awesome. Oh. Darius,
Yeah, I was going to just comment. I didn't know that we was paying unemployment taxes to the employers.
No, great. I'm glad you brought that up, Darius. So the way it works is for unemployment taxes, only your employer pays those. You don't pay those. Employer does.
Oh, okay.
So instead of you, so the way it works is for you, the employee, you pay the federal taxes, the state taxes, local taxes, and you also pay into Social Security and Medicare and all that stuff, right? That's what you pay. On the employer side, your employer, what they pay your match of Social Security, they pay your match of Medicare. but they don't pay the taxes, federal and the state. Instead of paying the federal and the state, the employer pays into federal unemployment and state unemployment. So that's how that works. Darius, does that help to clarify it for you?
Yeah, that's understood.
Yeah, great, awesome, cool. Questions? Any other comments, questions, concerns? Okay, well, thank you again so much for your time today. I sincerely appreciate it. If you have anything else that you can think of, you can email me, call me, set up office hours. You know I'm always here for you. And with that, thank you so much for your time. I appreciate all of you. Keep up the great work. I really do sincerely appreciate the work you're putting in. It means a lot to me. And I know it's a lot. It's definitely a lot of work. But I appreciate all of you. You're doing great work so far. Let's stay strong. Let's keep it going. We only got a few weeks left, so let's try to finish this course strong. And with that, if you ever need anything, I'm here. Thank you so much for your time today. Appreciate all of you. Have a wonderful rest of your night. Thank you so much. Take care.
Thank you, Professor.
Thank you. Thank you. Bye-bye.